Hi, ladies and gentlemen. Welcome to SA Accounting Academy. Here's a short clip on one of our previous webinars. I hope that you really do enjoy it.
Good day to you and welcome to this webinar dealing with IAS 38, Intangible Assets, presented by Anton van Wyk. For some background information about myself, you're welcome to have a read on the slide in front of you. And then I would just like to establish the agenda for today. Now, in this learning activity, we're going to be having a look at IAS 38. That's one of the older accounting standards that have not as yet been replaced by an IFRS. So it's still an international accounting standard dealing with intangible assets. There's, of course, a big link between IAS 38 and IFRS 3 business combinations, seeing that intangible assets feature quite prominently in business combination transactions because of IFRS 3 enabling, let's say in inverted commas, easier recognition of intangible assets at the acquisition date, because obviously whichever intangible assets are not separately established at the acquisition date will then clearly end up being subsumed into a goodwill figure at the acquisition date. So, that's why this link is established between this particular standard and IFRS 3 business combinations. So firstly, I would just have to, quickly want to look at an introduction to IAS 38, the standard itself. Then we're going to ask the question, what is an intangible asset really? And then other important aspects of intangible assets. And that means we're going to have a look at the underlying principles, not all of them that basic, but what are the principles that we have to consider in IAS 38 when dealing with intangible assets. All right, so let's get started. The more well-known or basic aspects of IAS 38 will obviously be the importance of classification of research versus development, because obviously using our definitions for research and development, it's very important that we classify correctly the difference between research and development costs, seeing that research costs are always expensed, whereas development costs are expensed in some instances, and in others they are capitalized should they meet the requirements of being capitalized. So that's one of the more well-known aspects of IAS 38. Consideration of the 6 requirements to capitalize development costs. I think most accountants are also quite aware of those requirements, and those of course have to be not just be satisfied but also illustrated that they are satisfied or demonstrated that they are satisfied before we can actually capitalize development cost. So what's important here is that those 6 requirements, which we'll have a quick look at later on, they are the requirements that all have to be satisfied before we can capitalize development costs in the statement of financial position. If we cannot demonstrate that all 6 those requirements are satisfied, the development costs must be expensed in profit and loss. And what is important to remember is that IAS 38 has this mechanism that once a cost has been expensed, it cannot subsequently be reversed and capitalized, seeing that future economic benefits now all of a sudden have now arisen which justify the capitalization of the costs. So that's something that you must remember. Unless there was a blatant error in respect of the prior period, then in terms of IAS 8, with all of the disclosure that accompanies such an error and the correction of an error, then we can retrospectively correct that error and restate the comparative figures correspondingly. But the general principle that we need to be very cognizant of is that once research or development costs. Now, research, that's not a problem because they must always be expensed and it stays expensed. But especially with development costs, there's sometimes a very fine line, because if you look at the process of research and development, research moves into development most often. So we can just see that the process of research resulting in expense of those costs that have been incurred, that process flows into a development stage. Now, some people think research, you must expense, and development, you must capitalize. That's not the case. There's a further expensing phase that goes into development. And we can only start capitalizing development costs the moment we can satisfy all 6 those requirements. So you can imagine how fine the line is at which point you cease the expensing of these costs, being development costs, and when you commence with the capitalization of the development costs as an intangible asset. And this is where it becomes so important to remember that mechanism in IAS 38 that says that you should not subsequently reverse any costs that have previously been expensed. And this will particularly apply to development costs. So just make note of that principle. Then also, the calculation of the amounts that are to be expensed as research or capitalized to development costs. So obviously, that allocation between research, especially, when staff resources and other resources are allocated to projects, we are all familiar with that whole calculation and allocation of costs between the research phase, the development phase that must still be expensed, and the development phase that then qualifies for capitalization as an intangible asset. Now, also something that is very important to remember when starting out your journey on IAS 38 is that you must ask yourself how the intangible assets were obtained. So, number one, this is the easiest one because these intangible assets are also simple to recognize, and that is when there was a separate acquisition. So if you acquired an intangible asset, that is the easiest intangible asset to recognize, because if you look at it, there were 2 parties. One party that sold an intangible asset and another party, which is you, who bought the intangible asset. So obviously 2 parties agreed regarding the existence of this intangible asset. So we must be realistic here. Had you acquired a building, there wouldn't have been an issue about whether there's an asset that exists or not, because both parties can see the asset. It's a physical structure. It's not something that has no physical substance and that one has to convince someone else that future economic benefits will flow from this particular resource. So the existence of the resource, when we look at items of property, plant and equipment and inventory and investment property, those kinds of things, the existence is never a problem. But when it gets to intangible assets, existence is a problem because there's no physical substance. We can't see the asset in front of us. So that means that this resource and the existence and the way that it's going to generate future economic benefits must be justifiable in some way. And that's why we're saying, if 2 parties have agreed on a transaction where intangible assets have been acquired from another party, okay, the one acquires it from another, that would mean that there would be 2 parties that actually confirm the existence of this particular intangible asset. The second one, acquisition is part of a business combination. So remember that these intangible assets are also acquired in terms of the business combination. Now, some of them are relatively simple, like trademarks and patents and all of those rights and, those assets that are specifically identified in the business combination transaction. But what you must also remember is what I said earlier about IFRS 3 on business combinations. IFRS 3 allows for easier recognition of certain intangible assets. And the reason for that is that intangible assets in a business combination are measured initially at their fair value. Now, fair value incorporates probability.
I hope that you enjoyed that video. For more of our webinar videos, go to www.accountingacademy.co.za. Thank you and have a lovely day.